Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate filings. Today we are diving into a report from Cogent Communications. Get ready for some number crunching, because we are about to see if Cogent's internet business is really surfing the web of profit or just stuck in the dial-up era. Scrorian States, Cresties and Exchange, Commerce Cogent Communications just filed a report called an 8K. This is like a corporate quick update letting investors know about big changes. In this case, it is about new debt they are taking on. This report is dated April 11, 2025, so it is pretty fresh information. The big news is that Cogent, through one of its subsidiaries or smaller companies it owns, got a new loan. Let's break down what that loan is all about. The company created something called Series 2025-1 Class A2 notes. Think of these notes as a fancy name for bonds, which are basically IOUs. They issued $174.4 million worth of these notes. That's a lot of money. These notes have an interest rate of 6.646%. That means Cogent has to pay that percentage of the loan amount each year as interest. It is also secured, meaning that if Cogent cannot pay back the loan, the note holders, the people who gave Cogent the money, get some of Cogent's stuff. In this case, it is related to their internet addresses. Cogent is expected to pay back this loan by April 2030. That is the anticipated repayment date, or ARD, so they have about 5 years to make it happen. This loan deal is managed through something called an indenture, which is basically the legal agreement. Wilmington Trust is the trustee, the entity that makes sure everyone follows the rules in the agreement. The report mentions the indenture a few times. Just remember, that's the main loan agreement. Cogent has to make interest payments every month. After April 2030, they also have to start paying back the principal or the main amount of the loan every month too. Here's the weird part. The final date to repay this loan is in April of 2055. That's way beyond the anticipated repayment date of 2030. If they have not paid it off by 2030, they have to pay extra interest. The extra interest could be quite high depending on how interest rates change over the next few years. It could be at least 5% extra per year. What exactly did Cogent promise to give up if they cannot pay back the loan? It is something called IPv4 addresses. These are basically the unique addresses that allow computers to connect to the internet. The loan is secured by these IPv4 addresses, customer leases for those addresses, and the money people owe them for those leases. All of that together is called IP4 address assets. Another company, Cogent IPv4 Holdco LLC, is guaranteeing the loan. This is like saying if the first company cannot pay, we promise to cover it. They are putting up their ownership of the company that took out the loan as collateral. This loan comes with a lot of rules called covenants and restrictions. Here are a few. First, Cogent has to keep a liquidity reserve account. Think of this as a rainy day fund to make sure they can make payments on the loan. Second, there are rules about paying off the loan early. Sometimes if they pay it off early, they have to pay extra as a penalty. Third, they have to maintain a certain debt service coverage ratio. This is a measure of whether they are making enough money to cover their debt payments. If they do not, they have to start paying off the loan faster. This is called rapid amortization. Fourth, they have to make sure their IPv4 addresses are being used. If too many addresses are sitting empty, they have to use the money they collect to pay down the loan. And if things get really bad, the people who own the notes can force Cogent to sell off the IPv4 addresses. Finally, there are a bunch of standard events of default. These are things that would allow the note holders to declare the loan in default, meaning Cogent has to pay it all back immediately. These include not paying interest, breaking the rules of the loan agreement, or going bankrupt. It seems that Cogent already had a similar loan. Because of this new loan, the company changed some of the rules in the old loan agreement. People who owned more than half of the old loans had to agree to these changes. The changes allow Cogent to borrow more money in the future. They also allow Cogent to sell off some of their IPv4 addresses, as long as they are still able to pay back their debts. And they can also swap out some of the IPv4 addresses that are securing the loan for new ones. So what does all this mean? Cogent is betting big on its internet business. They are taking out a lot of debt, hoping that they can generate enough revenue from their IPv4 addresses to pay it all back. They are walking a tightrope because if they do not meet certain targets, the note holders could force them to sell off valuable assets. Looking at this situation, there are definitely some risks to consider. Cogent is taking on a lot of debt and they are relying on a specific asset, IPv4 addresses, to pay it back. If something happens to that market, they could be in trouble. On the other hand, Cogent is an established player in the internet service provider space. If they can successfully manage their debt and continue to grow their business, this could be a good move for them. It is a high risk, high reward situation. In conclusion, Cogent is making a bold move to expand its business. Whether it pays off remains to be seen, but it is definitely something to keep an eye on. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. And let me know in the comments what company you would like me to decode next. Until then, stay informed.